My name is Brevin Welch.
And I'm Joel Hooper, and today we're going to be discussing two different companies that, while they may not be household names, they're definitely products you have definitely heard of and owned before. These two companies are Brown-Forman and Constellation brands, and they deliver beer, wine, and spirits. So let's go ahead and dive into our shareholders. Brown-Forman currently has outstanding shares of 307.95 million, with top 10 institutional owners being 12% of that. Some of these owners in Brown-Forman include BlackRock, Vanguard, and Goldman Sachs. Outstanding shares for Constellation brands is 166.5 million, with top 10 institutional owners being 32%, much more than Brown-Forman. They actually have similar owners in it, being BlackRock, Vanguard, and also JP Morgan Chase.
Let's go ahead and talk about why our investors care about the cost of capital. Let's start off with what the cost of capital is. Cost of capital is the economic and accounting tool used to evaluate a company's opportunity cost and help maximize potential profits. Why is this important? 1, you never want to miss out on any opportunities to invest when the time is right. 2, you want to be able to compare this cost of capital to any ongoing investments and see if it was the right investment indeed. Lastly, you want to be able to analyze where the funds are going, whether it's from the company standpoint or the investor standpoint. Next, we're going to get into what is our cost of debt financing. Cost of debt financing is the effective interest rate. In order to calculate that, we need to take that interest expense and divide it by the book value of debt. However, to be more precise and more accurate with our weighted average cost of capital, we need to take this after-tax amount, considering that the interest is tax deductible. So in order to get the cost of debt after tax, we go ahead and take the effective interest rate, multiply that by 1 minus the marginal tax rate here in the United States of 24%. For Brown-Forman, effective interest rate for them is going to be 2.89% multiplied by 1 minus that 24% to give us a nice 2.9% cost of debt. Follow that same formula for Constellation brands, and we'll see that their cost of debt after tax is 2.6%. And let's keep that in mind there.
So now that we've gone over a little bit of the cost of debt finance, let's hop into the cost of equity financing. So what we went ahead and did is we took the CAPM formula, which basically takes the risk-free rate, the beta, the market risk premium, and the risk-free rate again. So we have the 2.66% risk-free rate from the U.S. Treasury bond, the 10-year, plus the beta of 0.38 for Brown-Forman. Then you have the 8.66% market risk premium subtracted. You take the 2.66% and you end up with 4.94% cost of equity financing for Brown-Forman. Follow that same exact procedure, the only different number is a 0.76 beta for Constellation brands, and you end up at 7.22% cost of equity.
Now you might ask us, what is our overall cost of capital? Well, just keep in mind, the overall cost of capital is an illustration that shows the variation between what a company has invested in and what they should have but did not invest in. In order to find that, we're going to use this weighted average cost of capital. In order to be able to plug in every number, we use that cost of equity that we found for both Brown-Forman and Constellation brand, but we need to know the equity ratio. In order to calculate the equity ratio, we take the market value of equity, divide that by the sum of the market value of equity and the market value of debt to get that. Cost of debt, we take that number we found earlier, that 2.19% for Brown-Forman, that 2.6% for Constellation brands. Multiply that by the debt ratio. Check this out now. Debt ratio, very similar there, except it's the market value of debt divided by the sum of the market value of debt and equity. Normally, if we have any preferred stocks, we would include that in our denominator. However, in this case, we do not have any preferred stocks. Next, we're going to multiply that by 1 minus the tax rate of that 24%, and that's going to give us our weighted average cost. And for Brown-Forman, that number is 4.56%. Constellation brand, 6.02%.
So could we lower this by changing our capital structure? Well, after running our analysis, we definitely found that the debt ratio of 13.67% for Brown-Forman could be increased to the optimal 60% and positively affect the share values and firm value. The opposite would actually be true for Constellation brands. We found that the 25% was actually pretty optimal. If we did increase it, it negatively affected all the prices.
So would more debt create unnecessary risk? Well, let me go ahead and tell you a little about what I think about Brown-Forman. Brown-Forman does have the space to go ahead and collect more debt as it is doable for them. However, I see it as a riskier option considering it cuts into their large sum of equity that they've already acquired, and it may cause a shift in the company's value. And while we know higher risk, higher reward, I would kind of shield away from that. Constellation brands, on the other hand, already has a lump sum of debt that we have noticed. what more would a little more debt do to them that they couldn't handle?
So let's quickly dive into what the competitors do. The two competitors we chose were Diageo plc and Pernod Ricard. The reason we chose these two was because they're very close in market cap space, and the way we decided to weight them was taking their long-term assets compared to their total assets and their current assets to their total assets again. Diageo weighted much heavier in long-term assets to total assets, sitting at 86.53%, with current assets over total assets coming in at 13.47%. There are actually pretty similar numbers for Pernod Ricard, is 73.54%, and current assets to total assets sitting at 26.4%.
So is our stock price fairly valued? Well, for Brown-Forman, we found that the current price of a share is $48.24, and that helped us determine that compared to the optimal price, that the Brown-Forman stock is actually undervalued by a rough estimate of 38 cents. Over here, the Constellation brand, we found that compared to their current price of $166.98, they are overrated by $8.63 compared to the optimal price of $158.35.